American households now owe $18.8 trillion combined, an all-time record, according to the Federal Reserve Bank of New York's latest household debt report. Buried inside that record is a detail most headlines skipped. Credit card balances, the debt most associated with everyday financial stress, actually fell by $25 billion in the same quarter, down to $1.25 trillion. Mortgages rose, auto loans rose, home equity lines of credit rose. Only credit cards moved in the opposite direction. That split matters, because a record household debt headline sounds like uniform bad news. And it does not tell you what actually changed for ordinary people managing money quarter to quarter. Part of this record reflects expensive homes and cars people are financing at today's prices. Another part reflects households actively paying down the single most punishing kind of debt they carry. Those are two very different stories wearing the same headline number. Figuring out which parts of a record are genuinely alarming, and which parts are something closer to good financial behavior, is exactly the distinction most coverage skipped. Let us sort the signal from the noise. The New York Fed's household debt and credit report tracks every major category of consumer borrowing: mortgages, credit cards, auto loans, student loans, and home equity lines, using anonymized data pulled from Equifax credit records covering the vast majority of American borrowers. In the first quarter of 2026, total household debt held essentially flat at $18.8 trillion. A new record largely because it did not fall, not because it spiked upward. Underneath that total, the categories moved in different directions. Mortgage balances, the largest slice of household debt by far, rose $21 billion to $13.19 trillion. Auto loan balances rose $18 billion to $1.69 trillion. Home equity lines of credit, money borrowed against home value, rose $12 billion to $446 billion. Credit card balances alone dropped $25 billion, down to $1.25 trillion. That is a small percentage move on a national scale, but it runs directly against the trend in every other category. And it happened during a stretch when credit card interest rates remained near historic highs, which makes paying that specific balance down meaningfully harder to do by accident. Not all debt behaves the same way. And that is the point worth sitting with. Mortgages and auto loans are typically fixed payment installment debt, tied to a specific asset, a house or a car, and taken on deliberately at a moment of large purchase. Their balances rising mostly reflects people buying homes and cars at today's prices, not a sign of households losing control of month-to-month spending. Credit card debt works differently. It is revolving, unsecured, carries some of the highest interest rates in consumer lending, and often reflects near-term cash flow gaps rather than a planned purchase. Economists and consumer finance researchers generally treat a shrinking credit card balance as a meaningfully healthier signal than a shrinking mortgage balance would be, because it suggests households are actively working down the debt that costs them the most and offers the least benefit. A $25 billion drop nationwide does not mean every household is thriving. Aggregate numbers always average over enormous variation between people. But directionally, it is the opposite of what a household sector under acute, worsening financial stress usually looks like in the data. Delinquency data complicates a purely rosy reading. The same New York Fed report found overall delinquency transition rates held roughly steady rather than improving, meaning the share of debt slipping into serious late payment status did not meaningfully shrink. Alongside the credit card balance drop, some of the decline in credit card balances likely reflects genuine repayment by households with room to spare. But debt can also fall for less comfortable reasons. Lenders tightening credit limits and cutting off borrowers who are already struggling. Or households simply losing access to credit rather than choosing to pay it down. The report itself does not cleanly separate paid off voluntarily from access removed involuntarily within that $25 billion figure. And both mechanisms would show up as the same falling balance in the top line number. Total household debt also technically still hit its highest dollar figure ever recorded, even while flattening in percentage terms. So calling this purely good news skips over the fact that Americans collectively remain more leveraged than at any point in the country's history, regardless of which category moved which direction this quarter. Here is what this data cannot settle on its own. Aggregate national figures average across roughly 160 million credit-active adults. And a $25 billion national decline says nothing about whether any individual household is doing better or worse this quarter. It is entirely possible for the national credit card balance to fall while millions of specific households fall further behind. If paydowns among financially comfortable borrowers are large enough to outweigh distress among everyone else. And this report cannot distinguish between those two populations. The data is also a single quarter. And quarterly numbers in household debt reports move around for seasonal reasons, including post-holiday paydowns that regularly show up in the first quarter of any year regardless of the broader economic trend. Whether this specific drop reflects a genuine, sustained shift in household financial health, tightening credit availability squeezing out riskier borrowers, or an ordinary seasonal pattern will not be clear until at least the next one or two quarterly reports confirm or reverse the direction. This is financial information, not financial advice. And it says nothing about any individual's specific situation or what they should do with their own debt. Quick recap. Total U.S. household debt held at a record $18.8 trillion in the first quarter. Mortgages, auto loans, and home equity lines all rose. Credit card balances alone fell $25 billion to $1.25 trillion. Even as delinquency rates held roughly steady rather than improving. So, signal or noise, split verdict, and deliberately so. The record top-line number is real. And Americans remain more leveraged in absolute terms than ever before. That part is not noise. But the specific claim implied by most headlines, that this is uniformly bad news about households losing control of their finances, is noise. The one category actually falling is the debt most associated with financial distress. And that is worth noting rather than burying under a scarier record-breaking headline. Whether that fall reflects healthy paydown or tightening credit access is not yet answerable from one quarter of data. Watch the next couple of reports before deciding which story this number is actually telling. Subscribe for the numbers behind the headlines. Sorted from the noise. Signal from the noise. Every week.